Hello everyone, and welcome to this presentation of 5 reasons why your trading is not consistent. Welcome once again. My name is Steven Primo. I am the president and founder of Specialist Trading. Thanks for joining us today. And in today's presentation, I'm going to actually go into detail and show you what these 5 things are that are keeping you from being consistent. And as well, I'm going to show you ways in which to remedy and show you solutions so that you can get on that road to consistency with your trading. Now, if you're unfamiliar with Specialist Trading, we are an educational website. What I do is I give you all of the tips, techniques, and trading strategies that I've learned in my 37-year career of trading virtually all of the markets, and I share them with all of my students and my members. It's more of a mentoring class than anything else. We have strategies where we generate signals for all of our members, but what we try to do is fine-tune these strategies to meet your needs. So if you're an aggressive trader, you'll be able to pull the trigger, or if you're a conservative trader, we'll be able to fine-tune it so that it meets your needs if you're a conservative trader. Now, before we begin, this is going to be a pretty lengthy webinar, so I ask that you please take a moment to view our disclaimer. I'm going to show you some performance results pertaining to these 5 reasons, but please remember that we can in no way guarantee that any of the results I'm about to show you will be repeated in the future. Also, for people who are new to attending my webinars, I like to take all of your questions and answer all of them as much as possible, but please wait till the end of today's class to ask any questions, okay? We have a lot of great information to give you today, so get out your pencils and paper, and it'll run a lot more smoothly if we ask the questions at the very end. So if you happen to have any questions, write them down, and also write down all the information I'm going to be giving you. Probably the most asked question that we have from all of our people in the presentation is this is going to be recorded. So if that's your question right off the bat, yes, all of our presentations are recorded. You see under the chat box in the far right-hand corner, there is an email address as well as a phone number where you can contact us, and we will send you out a link to today's recording if you happen to leave early, okay? I'd also like to mention and invite you all to follow us on Twitter. You can see our name right there, our handle. That's @Specialist Trading, abbreviated to SPCLST-TRADG. We give a lot of great free information as well on a daily basis on our Twitter page. In fact, we give signals and we give some daily lessons on there as well. So a lot of great free information at Specialist Trading. Follow us on Twitter if you can. Now, I want to really teach you, and what I teach in my courses as well as in my presentations on a weekly basis, is to how to be consistent, because that really is the true definition, in my opinion, of what success is. I know a lot of people think it's how much money you can make or if you can earn a living off of trading, and really it's about being consistent. And the road to being consistent or successful is paved in simplicity. I used to trade probably the way the majority of you trade when I first started trading, trying to pick tops and bottoms and trying to use tons of indicators and listen to a lot of what people say. But my trading was not able to be consistent until my mentors taught me that I had to simplify things. So what you're going to be learning today are a lot of things that I'm sure you've heard of before, but I'm going to show you the right way in which to implement them. And they're extremely simple, but hopefully they will get you on that road to consistency. I'm going to show you what you've really been missing along your trading career. So my goal is to teach you how to trade with the specialist edge, the same edge that was taught to me that was able to get my trading consistent. And that's what I teach all of my students and members, and what hopefully I'll be able to instill in you today, the specialist edge, which is rooted in simplicity. All right, so let's start out. Once again, if you happen to just come in, if you have any questions, just kindly wait till the end of today's presentation. I'll answer them then, okay? Let's get on with the 5 reasons that are keeping you from becoming consistent. First of all, the facts are that 80% of all traders lose money. So if we had 100 people in the room today listening to the presentation, 80 of them would eventually lose all their money. And we don't mean you would go into a drawdown or go into some type of slump. Literally, you would lose all of your money that you have set aside for trading. The facts also state that 15% of all traders will just break even. Okay, so if we have 100 people in the room today, only 15 would be breaking even. And that's not bad, but you would have nothing to show for all your hard work that you're putting into the market and trying to learn how to trade. You would basically just be trading water. So what does this mean? Well, it means that only 5%, only 5 of you, if we have 100 people here today, only 5 of you will be consistently profitable. And if you want to see what this looks like on a pie chart, if we look at this large section in red here represents all the people that would be losing ultimately. That small slice in blue would represent the people that are breaking even, and that small little green sliver there would just represent the the percentage of traders that are ultimately profitable. This doesn't matter if we have 100 people in the room today, 1,000, or if we look at all the traders around the world on the globe. It will always be the same percentage points. So we have to ask ourselves, why is it that only a small amount of people are able to consistently capture the gains in the market while others are able to consistently have profits? Well, it's these reasons that we talk about. And I say this firsthand because I am guilty of falling susceptible to all of these reasons when I first started trading. I traded using all of these reasons that didn't help me make any money. I wasn't able to sustain any profits. I wasn't able to get forward on my trading until my mentors taught me what the reasons were. And there were actually 5. And I've come to see in my 37 years of trading that most traders fall to the wayside in their trading because they were employing these reasons. And it's funny because most of the time we have been taught through conventional wisdoms that these are the things that are going to help us become successful, but conventional wisdom is not always correct. So reason number 1 going down in our presentation today of why we are not consistently profitable is because you rely too heavily on news. I know I was taught right off the bat that I should know everything about the companies I was trading. I should know all about the news, every earnings event that came out, any global event, economic report, any jobless claims I should know about, and it's going to help me in order to become a better trader. Well, my mentors taught me that this is not true. And the reason why is because news is subjective. Someone can read the news and say that's tremendously bullish, and you can have another trader reading the exact same news and say that's tremendously bearish. And at specialist trading, we want things that are cut and dry. With all of our rules, all of our techniques, regardless of their indicators or patterns or news, we don't want to have one person seeing one thing and the other person seeing another. So news is not only subjective, it's after the fact. Okay? A lot of times, even if the news is correct, if something that is supposed to be good for the market, many times it happens after the stock or the future or the commodity has already gone up. So we don't want to be chasing things. We want to be more in sync with what the market's doing. And we don't want to be relying on something that is subjective and after the fact. Let me give you an example here. And I'm going to show you a lot of examples in today's presentation. They're a lot older, they may be 1 or 2 years older, but I'm showing them for educational purposes. At the end of today's presentation, I will put it all together with some examples that are as old as yesterday, that happened actually yesterday in yesterday's market. So let's start off with an older example that came out in August of 2012 in the LA Times. And it stated in the headline, Apple becomes the biggest company in U.S. history as its stock reaches $623 billion. Basically, it says that Apple has become the most valuable company in American history. Okay, tremendous news. The company's value rose to $623 billion, beating the record for market capitalization set by Microsoft. The stock has hit new highs recently because of optimism around what is believed to be the impending launch of the iPhone 5 and possibly a smaller, cheaper iPad. So anyone looking at this would say, boy, that's great. You have to buy the stock. And for an investor, you have to hold on to Apple because it's a tremendous stock. It's the largest stock in history, and only good things can come out of this. Okay, so if we look, we see here that the stock had been going straight up. And right here, circled in green, this is where the good news came out. Okay, and then look what happened. It dropped 25% in the next 3 months after that. Okay, what happened to the good news? Was the good news only good news for the next couple of months, or was it after the fact and a little bit too subjective? Now, following this, as the stock went all the way from 700 all the way down to 500 roughly in the next 6 months, 3 or 6 months, guess what the news was in April of 2013, just about 6 months later? Apple drops below $400 for the first time since 2011. Apple accelerated losses, tumbling to its lowest level in over a year as investors continue to drop shares of the tech company amid worries over second quarter iPad mini shipments. Okay, now the news is terrible. Anyone looking at this would say, well, that's got to be bad. If I'm an investor, I should probably sell this. So you exit right there around 419, and look what happens. Up 60 points in 2 weeks. And this was an older chart going back to May, roughly about 9 or 10 months ago. We all know that the stock is much higher now. So do you see how the news really would not have helped us in any of the situation? In fact, if we look at this chart, here's where the good news came out, way here, up here at the top levels, and here's where the bad news came out. All right? Now, I'm not going to sit here and tell you that this always works this way, that anytime good news comes out, whatever you're looking at will go straight down and vice versa. All I'm saying is that we want something more cut and dry, or something that is a little bit more consistent. and not so subjective or after the fact, because this is not going to help us with our trading. All right, something that works some of the time but doesn't work a lot of the other time is not going to help us. This is one of the main reasons why we're not successful. Okay, let's go on to reason number 2, why we're not consistent in the markets. Because you are trying to pick tops and bottoms. All right, I know this firsthand because for the first year or two when I was trading on the floor of the stock exchange, this is the way I used to trade. Okay, and it used to work fantastic for a couple of trades, and then it would just work terribly, and I'd give everything back. Let me show you an example here, going back in the E-mini to show you how all this works in every time frame in every direction. Now this is a daily chart of the E-mini, an older chart, and as we see here, when people try to trade overbought and oversold scenarios, usually what you'll do is you'll use an overbought, oversold oscillator, some type of indicator. All right, this is just your standard slow stochastics, and conventional wisdom tells us that when these two lines cross over in the so-called overbought territory, that's where you should short it. And when they cross over, getting close to or touching the oversold territory, that's where you should buy it. So these two trades worked out really nice. Had you sold right here, you would have had a nice gain of roughly 20 or so points in the E-mini, and had you purchased right here, you would have a nice gain there. So looking at these first two scenarios, this worked very well. I'm sure you would say, well, Steve, what are you talking about? Picking tops and bottoms works nicely. It works nicely. I wouldn't disagree with you at all. It works nicely until it doesn't work at all. Because if we go further into the future, we look at the same chart and see that, well, we got another crossover here telling us it's time to sell. So you would have exited your long position and gone short, and you wouldn't have had any movement to the downside except another sell signal. So you would have doubled up, and guess what? It just keeps going higher and higher until you gave everything back that you made on these first good trades. Okay, does this look familiar to anybody? Anyone who tries to trade tops and bottoms knows that it can work tremendously well until it stops working. And it's not just a scenario where you're trying to short, it can also work where you're trying to buy. Here's a chart in the E-mini from this past week. All right. Now, if you use this same scenario of trying to buy and pick bottoms, guess what? All of these areas here would have been places where the indicator told you that we were oversold and it was time for a bounce. And you would have continued to buy until ultimately you probably would have given your whole account up in one or two trades here. So you see how this is really a sucker's bet. Trying to pick tops and bottoms is similar to gambling and playing the slot machines. You know, slot machines are probably the worst statistics you have of any gaming type of fun or pastime at a casino, because the odds are so stacked against you. What they do is they give you this false sense of security where they let you win a little every bit, every once in a while. But over time, pretty much you've used all of your money for gambling, because over time you will lose everything. It's the same scenario. It's the exact same thing with picking tops and bottoms. From time to time, you'll have a winner where you think, boy, this is fantastic. But over time, if you continue to use this technique and this method, you will ultimately give everything back. It's a recipe for disaster. And I'm saying this firsthand because this is the way I used to trade. So what's the lesson learned for trying to pick tops and bottoms? Well, what my mentors taught me when I asked them, I said, well, why can't I pick tops and bottoms? They said, because there is no such thing as overbought or oversold. Any trading market that you're looking at, anything, it doesn't matter if it's futures, stocks, or the forex markets, it can go as high as it wants and as low as it wants, down to zero. We've seen this happen. So there's no such thing as overbought, oversold. This is just a bill of goods we've been sold. Remember, this is conventional wisdom that really doesn't work. So don't ever get stuck in the trap of thinking that something is overbought or oversold. It can go as high as it wants to or as low as it wants to. All right, reason number 3 why you're not consistent in your trading, you are out of sync with the market. We've all been told that you have to be in sync with the market. You have to trade with the trend, but most people have a different idea of what the trend is. So that's why it's so difficult to trade with the trend. Here's an example in CRM this past year. As we see here, the stock had been going straight up, but then it looked like it was rolling over and starting to head lower. So at this point, you say, well, it looks like it's topped out. I'm going to sell it and get out of the stock, and then look what happened. Okay, you're out of sync. It was actually still going up. Or Apple, how about in this older scenario, we see here that the stock had been heading lower, and guess what? Off of news or off of something that happened with the stock, it goes straight up in the next 2 days. So you think, wow, it's time to get into this stock. I'm going to cover my short, or I'm going to start to look to go long Apple, because it's really just headed straight up. This is a good sign. And then guess what? By the end of the month, it's making lower lows, okay? Look familiar to anybody? Here's how we can remedy this, by using our buy-sell line. The buy-sell line tells us which side of the market to be on. Therefore, we are in sync with the market we're trading. And all the buy-sell line is the 50-period simple moving average. That's all it is. But what you have to do is plot a 50-period simple moving average on every chart you have. It doesn't matter if you intraday trade tick charts or if you only look at monthly bars. It doesn't matter if you trade the Forex or if you trade stocks. You must always have a 50-period simple moving average plotted on your chart. And in order to use this correctly, what you have to do is ask yourself before you pull the trigger, or any time you're interested in trading, always ask yourself first, where is price in relation to that buy-sell line or 50-period simple moving average, okay? I'm going to say this again. You may want to write this down. Where is price in relation to the buy-sell line? Ask yourself that before you pull the trigger on buying or selling. Why? Because if price is above that buy-sell line, then you should only be looking for buy setups. That's it. You should never even consider going short. And if price is below that buy-sell line, you should only be looking for sell setups, or you should never consider going long. Okay? Let's look at those examples again. Now, we originally wanted to sell or get out of CRM because it looked like it was rolling over. But if we applied the buy-sell line, we ask ourselves, where is price in relation to that 50-period simple moving average? Price is above. So there's no reason to even consider going short. We should have been looking for buy setups. How about Apple? Originally, we thought, wow, this had a really nice spike up, so we wanted to go long. But if we added the 50-period simple moving average, we ask ourselves, where is price in relation to that 50-period simple moving average, the buy-sell line? Price was below. So if price is below, we should only be looking for sell setups, shorting setups, and we should never consider going long. This is how you're in sync with the overall market. It's the easiest but most powerful way we know of being in sync. And trust me, this will save you out of so many losses. This is one of the most important rules I ever learned on the floor from my mentors. And if there was one thing I could use for the rest of my life, if I couldn't use any other technique or tip that I've accumulated in my career, but I could only use one, this is what I would be using. I really feel so strongly about this buy-sell line. In fact, if we look at that old chart again of Apple, and we see how where the good news came out at the top and where the bad news came out at the bottom, all we had to do was apply the 50-period simple moving average, the buy-sell line. And even if we had taken advantage of buying here and selling here, the 50-period would have gotten us out. We could have exited once we saw that we were below, and we could have covered our short and got long and saved ourselves a lot of money. Even though we would have had losses, they would have been minor losses as opposed to major losses, the way some people who held on to Apple all the way until this news came out down here, and then they sold it at the very bottom. Now remember, this works not only in stocks, the Forex markets, it works in the futures markets, the commodity markets as well, and it works in any time frame. Remember the flash crash in May 20 when all the markets just fell out of bed, thousands of points, and people said, boy, there's no way you could have made money on that day. Well, that's not true. Here's an intraday 5-minute chart of the E-mini on that particular day, the flash crash, and we ask ourselves, for that entire day, where was price in relation to the buy-sell line? Well, for 99% of the day, except for a few small pop-ups above the 50-period, the price was below. So this was telling us we should only have been looking to go short. And most of our traders had a fantastic day during the flash crash because we had some great signals that were able to get us to go short, and look at the profits we reaped out of this. Why? Because we were in sync with the market. We weren't trying to pick a bottom at all. The only people that got hurt during the flash crash were people out of sync of the market trying to pick a bottom. All right, reason number 4 that you are not consistent in your trading is because you're not listening to the market. My mentors taught me that. They said, Steve, you are involved in far too many news events. You're listening to too much news. You're subscribing to too many trading gurus. At that time, we had subscription letters. Now they would be called trading rooms or chat rooms because there was no internet then. I had too many indicators plotted on my screen. I was just listening to all these outside things trying to give me an idea of what to do, listening to my friends and other traders give me ideas and who do you like, what do you think of this stock, what do you think, rather than listening to the most important thing my mentors taught me, and that's the market. And I said, well, how can I listen to the market? Well, what do I do? And they said, Steve, the market is always giving you clues, always giving you hints as to what it's going to do. And this is the source of what your trading is based off of. So why listen to outside things instead of what the source is? And that's the chart in front of you. So I said, well, how do I do that? And they said, you can start by looking at the most valuable chart pattern there is. And I said, what is that chart pattern? And here it is. It's simply a bar that closes in the top 25%, whether it's a 5-minute bar, a 30-minute bar, a daily or weekly bar. But when you see a bar that closes in the top 25% of its range, the market, not an outside source, not a trading room, not some guru, not some guy on TV, but the market itself is giving you an indication to buy. It's not telling you to buy, but it's giving you an indication that most likely it's going to go higher. Conversely, if you see a bar, whether it's a monthly bar, a weekly, daily, or even 5-minute bar, close in the bottom 25% of its range, you're getting a tremendous clue that the market's most likely going to be going lower. It's an indication to sell. So, as we stated, the same thing I asked my mentors. Why is this so important? You may want to write this down. When a price bar closes, either at or near the top or bottom of its range, the market, not an outside source, not a trading room, not some guy you watch on TV, not your best friend down the street who trades for himself, but the market itself, the most important thing you should be listening to, is giving you a clue as to which direction it wants to go. What a tremendous clue. What if the market itself that you're trading, that you're buying and selling, were giving you personal clues? So this is a tremendous, tremendous way to listen to the market. Here's an example in Tiffany. Now, in hindsight, we see that the stock literally went up in this example here. It had some really nice movement. And looking back in hindsight, once again, it's easy to say, well, yeah, sure, well, you would have been long the entire time. Well, what if we were looked at every time we had a nice run-up in the stock, and every time it pulled back or sold off, was there some type of clue the market was giving us that it was going to go, an indication it was going to be headed higher? Well, if we look at this first run-up we had here, we sold off after that. And guess what? We had this confluence of all these bars circled in green that closed in the top 25% of their range, followed by 7 points higher. Then we sold off again, followed by these nice bars here that all close in the top 25% of their range, followed by another 3 points higher. Another sell-off, followed by a bar that closed in the top 25%, 3 more points higher. Another sell-off, followed by 2 more bars that close in the top, another 4 points higher. Now remember, this has to be coupled with the buy-sell line. This also has to be coupled with other things, but these are clues that tell you what direction the market wants to go. It wouldn't matter if this were a 5-minute bar chart of Tiffany or a monthly chart of Tiffany. Now let's go to reason number 5, why you're not consistent in your trading, and that's because you are using faulty entries. Many times you actually may be on the right side of the market, you may be not trying to pick tops and bottoms, and you're doing everything right except for your entry. I know so many traders that the minute they have a good feeling about a stock or future, they just jump in. Just jump in, buy at the market without any consideration of where they're buying. They say, I just got to get in. Or else they get scared and they exit and they say, it's time to go short. You got to sell everything. And they could be the right decision. It's just that they're making their decision based off emotion or based off of what someone else is telling them. All right? So here's a perfect example in the British pound for all you Forex traders. Now, right off the bat, we're above the 50-period simple moving average. And we see a bar here that closes in the top 25% of its range. Coupled with some other things you may be looking at, this is a buy signal. You want to go long the British pound. So rather than sitting back and looking for a nice place to enter, you just simply buy at the market. And guess what? In the next 3 days, it goes straight down. Now, it doesn't look like a lot of movement, but if you had traded only one lot of the British pound, you would have lost over $1,000 in the next 3 days. So at this time, you'd probably say, okay, I'm throwing in the towel and I'm exiting. And so you would have exited the trade for a $1,000 loss, and look what happens. Okay? So you see, you weren't wrong. It was the right thing to go long. It was just that your entry was faulty. And you entered at the wrong time, you got scared, you threw in the towel just at the point where you probably should have been entering. So how can we alleviate this problem? By using our confirmation method. So what exactly is the confirmation method? Well, it's the verification that the trend has resumed in your desired direction. So in other words, if you're wanting to go long, you want to see that the trend has resumed or is going upward. If you're going short, you want to see that the trend is resumed on its downward course. This is your only signal to enter the trade. A true specialist always waits for his trade to be confirmed before entry. He just doesn't simply blindly jump in or try to pick tops and bottoms on his entry. He waits for confirmation. So here's what, in a nutshell, these examples of what confirmation is. If we're buying on pullbacks, we see here that if our signal was generated somewhere around here, we don't want to simply buy at the market. We wait for price to trade one tick above the previous bar's high. And we continue to wait until you see price traded above the previous bar's high right here at this green horizontal, and that's where you enter. And as you can see, once you entered, then the trend resumed. It would be the same thing going short. If we see that the market is falling out of bed and we simply sold at the market here, well, we would have probably gotten stopped out in this little pullback or rise up. Rather than that, we wait for price to trade one tick below the previous bar's low, and that's where your entry is, right there. And you see the trend resumes lower. Now, the purpose of waiting for confirmation is not only to get us in at the beginning of a trend, as you just saw, but also to keep us out of bad trades as well. And this is a great tool because many times it will keep you out of a trade that was destined to go in the opposite direction. So as we see here, let's say that your strategy gave you a signal and you said, well, I'm not going to buy the way I normally do at the market. I'm going to wait for confirmation. So I'll wait until we trade one tick above this bar where I got a signal to go long. Okay? And if you continue to wait, we never traded one tick above the bar. So at this point, you probably would have said, boy, I don't think it was a valid buy signal, and you would have saved all that money. You see how this confirmation technique kept you out of trouble. So let's put it all together. What if we put all these reasons and all these things that can fix those reasons, which I've shared with you, all together and put them in together in a strategy that only has roughly about 5 rules? Well, we did. This is probably our most consistent strategy because it is such a great strategy because it transfers over easily onto any market, any time frame. This is strategy number 4. Let me share with you a brief overview of how strategy number 4 works. It is basically designed to trade quick momentum moves. In other words, you're only in the trade usually from 1 to 5 bars. But we have also ways in which to stay in the trade longer once you become a member of Specialist Trading. So if you really want to capture as much points as you can, we teach you ways in which to stay in the trade much longer. Its intensity level being the most intense, meaning that you have to watch every tick, you can't walk away from your computer, and 3 being the most relaxed where you basically just enter an order and walk away. Well, this is right in the middle. It's a 2. So it's a very moderate strategy to trade. Its main indicator, well, there is no main indicator because it's a pattern recognition strategy. We're looking for a specific pattern within roughly 5 to 10 bars. Okay? So that's what we're looking for with this particular strategy. And it's very simple. Once we teach you what this pattern is in our courses, it's very simple and easy to recognize. Remember, this works in any time frame, any direction, any market. I traded it today on a 2,000 tick bar chart of the E-mini, and I had a nice profit today trading it. But we have just as many strategies, signals in the Forex markets as we do in the stock market. You see tons of these every day on daily bars in the stock market. So it's a great strategy. It's probably one of our most consistent strategies, and it transfers over onto any market. All right, so let's look at some recent trade examples using strategy number 4. Remember, it takes into account all the things we talked about so far, the 5 reasons why we're not successful, and all the things, the results we used from using the techniques to alleviate those 5 reasons. Let's start out with some stocks, and let's start looking at FSLR for solar. Okay, this has been in news a lot. It has a really nice movement lately. If we go back to roughly a week or so ago, we see that price was hovering mainly above the 50-period simple moving average. So as you can see, even though we had one close on or below, for all intents and purposes, price was above the 50-period simple moving average. And here we have a bar that closes in the top 25%, plus it met all the requirements of the strategy, which we can't share all of them with you. But the 2 rules we can share with you are actually 3 rules. Price has to be above the 50-period simple moving average, which it was. It has to close above. We have to have a bar close in the top 25% of its range, and then our entry can only be if we trade above it. Okay? So we're using 3 of the rules and the techniques I shared with you just a few moments ago. So as we see here, on the very next day, we would go long if we traded anywhere above the top of this particular day. Well, we opened roughly about a point higher, roughly about 56, so we would have entered right here, and then we all know what happened in the next 4 days, up 18 points in 4 days. Now, we're not saying that you would have stayed in this entire time, but you would have had a profit with this trade, and if you wanted to, you could still be in this with the techniques we share in the course. This was an actual signal that our members took in FSLR last week. How about LinkedIn? Okay, the first thing we ask ourselves is, where is price in relation to the 50-period simple moving average? Obviously, price is below, so we're not even going to consider going long LinkedIn. We're only going to look for shorting examples. Now, if we're strategy number 4 members, we see here that we have a setup bar right here. It meets all the rules in the course, plus we have a bar closing in the bottom 25%, and we'll only go short if we trade below it. Well, the next bar traded below it, and our members got short, and had you been a member, you would have made 12 points in 1 day. How about the E-mini? Well, if we look at this hourly chart, which goes back to the 13th, which was less than 2 weeks ago, we see here that the majority of price coming in was below the 50 period. We have a bar closing in the bottom 25%. We entered on the next hourly bar here, and you could have made 24.5 points in 1 day on an hourly bar signal. How about on a 10-minute chart going back to last Friday and yesterday? This was last Friday. This was yesterday morning's action. Friday started out the day above the 50 period, but then went below it. And then coming into Monday, yesterday, we were well below it. And we see we have 2 signals here. The first one was to go long on Friday, which would have made a quick 4.5 points. No signals for the rest of the day on Friday on this 10-minute chart, but on the very opening bar on Monday, yesterday, we had a strategy number 4 signal to go short, where you would have entered and you could have made a quick 15.5 points in the next hour, the first hour of the trading day on a 10-minute chart. This is actual strategy number 4, sell signal. How about the Forex markets? Well, here's a signal that we actually generated and posted on Twitter, and all of our members who are strategy number 4 course members were able to take this trade. We sent out a signal the night before. But as you can see, we're above the 50 period, so we're only looking to go long Canadian dollar, the Canadian dollar. We closed in the top 25%. We met all the other rules, so we would have entered once we traded 1 pip above the high of this bar and 120 pips in 1 day, which would roughly be over $1,200 in just trading 1 lot. And then lastly, Australian dollar. We're well below the 50-period simple moving average, so this tells us, the overall market tells us, in order to be in sync, we can only look to go short the Australian dollar. We're not going to even try to consider picking a bottom. We see here that we have a setup to go short. We close in the bottom 25%. It met all the other rules, which I'm sorry we can't share with you right now, but I can share with you we are below the 50. We closed in the bottom 25%, and we went short once we traded below that signal bar. And in the next 2 weeks, we went down over 290 pips, or roughly about $2,900, just trading 1 contract. Now, I'm not going to sit here and tell you that every trade works this great, okay? It wouldn't be fair, and it's not true. There are some losers, whether you're trading a 5-minute chart or whether you're trading a daily or a monthly. And there are losers in every market. So we have to ask ourselves, even though these are high probability setups, and we really feel that they'll get you on that road to consistency, can we increase our odds for success even more? Well, the good news is yes, we can increase our odds for success even greater. And this is by adding the PET-D. This is the Primo Early Trend Detector, the abbreviation for the PET-D. So what exactly is it? It's a proprietary color bar algorithm. And what we do is we automatically, once you become a member, you get the add-on which automatically colors the bars anywhere from green to red. And when you get a series of green bars, this is telling you now that the short-term trend is up. Remember, the 50-period simple moving average tells us the overall trend, but the PET-D tells you the short-term trend. Also, when you get a series of red bars, this tells you that the short-term trend is down. So think of the possibilities when you add these two together. When you add this along with the high probability techniques that I just shared with you, you've increased your chances for success tremendously. So how do we implement this? How can we use this along strategy number 4? Well, if you get buy signals, and it doesn't matter even if you're trading strategy number 4, this could be virtually any strategy, whether it's one of your own or another one of our strategies. Once you get a buy signal, only take trades where the signal bar is colored green, because the PET-D is confirming that that's a good signal to take. And conversely, if you get a sell signal, regardless if you're trading one of my strategies or one of yours, only take the trades where the signal bar is colored red, because the PET D will be in sync with what your strategy is telling you to do. So let's look at an example here going back this last month in SNDK. All right, we had 3 signals here that our software automatically generated for us to go long. Okay, why? Well, because we're above the 50 period simple moving average. Okay, our close was above. We closed in the top 25% in all 3 of these, and it met all the other rules, which I can't disclose now to non-members. But as we see, these 2 signals worked out great, but this one didn't. Okay, so how could the PET D have helped us? Well, remember, if we're going long, we need to see the setup bar. That's the bar prior to entry. We need to see that it's green. All right, so if we look at these bars here that worked out, they were all green. You see that? And the trade that didn't work out was marked red. So do you see how the PET D would have kept you out of this losing trade but gotten you into the ones that worked out? Here's another example in Avon, AVP. This was just this last couple of weeks ago. We ask ourselves, firstly, where is price in relation to the buy-sell line, the 50-period simple moving average? Obviously, price is below, so this means we're only going short, and the software generated 2 sell signals in Avon. Now, this one, actually, if you held on long enough, probably would have worked out nicely, but most people wouldn't have. You most likely, once you had this nice blip, would have gotten stopped out if your stop was anywhere up here. Okay? So both of these signals should have been colored red in order for us to go short, meaning that the short-term downtrend was being confirmed as going lower. Well, we see here that this was colored green, telling us not to go short or not to take this trade. So we would have waited and then taken this colored in red, and as you can see, it worked out nicely to the downside. How about Facebook? Okay, this is once again from the beginning of March, just this last 3 weeks. Where is price? Well, price is above the 50, so we should only be getting buy signals. All right. Now we see 2 trades here. One worked out nicely. The next trade didn't work out very well at all. Okay. So we should have, if we added the PET D, how could it have helped us? Well, we want to see that both of these signal bars are green. Well, the first one was green, giving us the green light to take the trade. The second one was colored red, so you never would have even taken this trade, and you would have sidestepped all of these losses here. If we look at the E-mini, this was on Thursday of last week, just about 4 days ago. We see here that price was above the 50-period simple moving average. We had 3 signals on that day on a 5-minute chart on last Thursday. Okay, right here, this one worked out nicely. This one was okay, but this one would have been a loss. So we want to see the PET D help us. So the PET D would have to tell us that all these signal bars should be colored green. Well, this one was colored green, and it worked out nicely. This one was colored green, and we would have had a nice profit. But guess what? This one was colored red, giving us an early warning not to take this trade. And it was good that we didn't, because we would have had a loss. Remember, this will work on any strategy you have or any trading technique. Now, this is not just akin to strategy number 4. If you have another one of our upwards of 10 strategies, or if you're trading one of your own, you can see how well this would work in keeping you in sync on the short-term trend. How about the euro-yen? Well, we see here that we were above the 50-period simple moving average in this euro-yen trade, and we got a buy signal right here, but it was colored red. Now, this would have worked out for a little bit, but you would have had to been very quick and exit this trade. You couldn't have stayed in it longer. It would have been more conducive to profitable trades if we would have taken this one to go short. Why? Because it was colored red, and look what happened. All right, so let's review. Let's go down these 5 reasons that are keeping you from becoming consistent in your trading. The first one is relying too heavily on news. Remember, I used to listen to everything, every news event, every indicator, indication that came out with employment numbers, with jobless claims, everything relating to earnings, and it was too subjective, because I would think it was totally positive and the stock or the future would go straight down, and vice versa. So it's not cut and dry. And another way is relying too heavily on news is because you're looking for an outside source to tell you what to do, which is the news, rather than focusing on the market itself. So if you really feel that you must focus on news, you take it with a grain of salt. Instead of relying on 90% of your decision-making process on news, maybe cut it down to 10 or 20%. Okay? don't rely too heavily on news. Now, obviously, if you're a long-term trader, if you're an investor and you're looking at a portfolio long-term, sure, you definitely have to take the news into account. I will be the first one to tell you that. You have to know what a company's doing. You have to know the economic situation. But if we're trading and we're holding something for anywhere from 1 day to 2 weeks, there's no reason you should be concerning yourself with news. I never even consider looking at news in my trading. Number 2, you're trying to pick tops and bottoms. Remember, this is a sucker's bet. In my opinion, I know this firsthand, okay? I know so many traders, myself included, who would trade tops and bottoms, and it would work fantastic, and we think we had the holy grail, and then there would be that one trade where it didn't work, and you give everything back. So remember, as people who are trying to become consistent, you want to trade things that are consistent. You want to trade techniques that are consistent, and there's no consistency in trading tops and bottoms. So you should really just let go of any type of top or bottom type of strategy. Why? Because as my mentors taught me, there is no such thing as overbought or oversold, okay? It's just something we've been sold. But we know that any market can go as high as it wants, and any market can go as low as it wants. Number 3, well, the reason why you're not consistent is because you're out of sync with the trend. Most people want to be in sync with the trend, but they're using the wrong tools to help them. We feel the most powerful tool is the 50-period simple moving average, the buy or sell line, okay? And all you have to do is ask yourselves, where is price in relation to that? If price is above the 50-period, you only want to be looking for buy setups, and you will never, ever be shorting anything above the 50. If price is below, you only want to be looking for sell setups, and you will never, ever look to go short. Now, obviously, and I have students tell me this on a daily basis, well, Steve, I didn't go short, and the stock went straight down, or the future went straight down, or I didn't go long, and it went straight up. And I said, yes, this will happen from time to time. There are always going to be exceptions to the rule, but we're looking at consistency, which is 2 steps forward, 1 step back. So we're looking for things that will work over time. Remember, we're not just looking to hit a home run and continue to trade when price is below to buy, look for bottoms, and price is above to look for tops. We're not looking or concerned with that. We're looking for things that have a 2 steps forward, 1 step back approach. And when you use the 50-period simple moving average, you'll get on that road to consistency. Remember, it's the one thing I would only use if I couldn't use anything else. The 4th reason why you're not consistent, you're not listening to the market. And when we say listening to the market, we say look at the bars. If a bar closes in the top 25% of its range and it's above the 50-period, it's giving you a clue it wants to go higher. Conversely, if it's below the 50-period and closes in the bottom 25%, it's telling you it wants to go lower. And then lastly, using faulty entries. We know that so many students we have that become members say, Steve, I'm on the right side, but it's just my entry. I'll get in too early or too late. Once you use the confirmation technique, which states that don't buy at the market, but wait for price to trade 1 tick above the previous bar's high, well, then you will be in sync and you'll be having a higher probability chance for entering once the stock or whatever you're trading goes in your direction. So if you get a buy signal, only buy if price trades 1 tick above the previous bar's high. If you get a sell signal, regardless of what strategy you're trading, only sell if price goes 1 tick or 1 pip below the previous bar's low. And then lastly, if you want to kick up and ramp up your odds for success, always trade with the pet D. Why? Well, because now you are in sync with the short-term trend. The 50-period will get you in sync with the overall, and the pet D will get you in sync with the short-term trend. Now, in the last couple of minutes before we go into questions, I want to invite you all to take advantage of a great combo we have where we're offering not only the momentum strategy number 4, which works in any market, any time frame, but we're coupling that with the PET D, the Primo Early Trend Detector. Usually we sell these separately, but we're giving you these 2 great, fantastic techniques, these 2 methods for the price of 1. And we're also throwing in bonuses. Now, one of the great bonuses with the PET D is that not only can you use it to verify whether you should be going long or short, but you can also use it as a long-term directional tool. This is a fantastic way to actually be on the right side for long-term markets as well. Now, if we look at a monthly chart of the S&P index, we see here going back to 1994, all the fantastic upswings followed by downswings followed by upswings and vice versa. So how would you like to have a tool that was able to get you in sync with these nice big swings? Well, if we add the PET D, guess what? We have a confluence of green bars here until we have a majority of bars turn red and you can be out of the market. We had the great tech bubble burst, and then once we have consistency in green again, it's back to get back in the market until we see the banking crisis here at the beginning of 2008. You could have exited and missed all this and then got back in the market and continue to be long up until now. Now, when this turns, the PET D will also turn and change red again. So this is a great technique that you can use as a directional tool on top of helping you to fine-tune your entries and confirm your trades. So we're offering both of these. Strategy number 4, which we shared with you and showed you all the great signals in all markets and all time frames, along with the PET D, along with these bonuses. Now in the PET D course, you also get 4 different techniques in which to trade just with the PET D. Now if you purchase these separately, it probably cost you thousands of dollars. We're going to reduce the price down to $14.95 to get both of these together. And the beauty of this is we're now offering payment plans. So $14.95 is a little bit out of your reach. Don't worry, you can call one of our trading consultants and we'll work with you either on a weekly or monthly basis to have a payment plan so that you can meet the needs and get both of these great techniques for the price of one. But remember, this is for a limited time only. Strategy number 4, which is something I use each and every day in my trading, as well as the PET D. I personally use this each and every day, and they can be yours. This comes with instant course access. You can be logging on and having this available today. It comes with 5 videos for detailed instruction. We also teach you all the entries, all the exits, and all of the stop techniques. This also comes with signal alerts. So we will share with you emails on a daily basis when signals are provided in the different markets. We also give you weekly trading lessons such as you're seeing today. This includes both add-ons. You can use the add-on onto your trading platform so that with the strategy number 4, you will get up and down arrows telling you when a signal has been generated. And with the PET D, you will upload that and you will see that all the bars either turn red or green. And lastly, access to my personal email where you can ask me questions anytime you like and I can answer them for you as my student. Remember, this would roughly cost you thousands of dollars for both of these individually. We originally had this combo set at $19.95. We've reduced it even more for a limited time only down to $14.95. Plus, we've included payment plans. Okay, so if $14.95 is still out of your reach, don't worry. We will work with you to meet your needs so that you can become a member and have both of these techniques for a limited time only, though. Now, for more information, you can also go to our sister site. That's Pro Trader Strategies. That's the site where they market and have all of our different individual strategies and courses for sale. You can also contact one of our trading consultants at trading@protraderstrategies.com. You can email us there, or you can call us directly at area code 310-598-6677. Okay, if you give me just a moment here, I will open up the question and answer box to answer any questions that you may have. Let me just go down the list real quickly here. I know people are asking about the stops. Steve, where are the stops? And Jeff, that's a great question, but that comes with the course because we have roughly 4 different stop levels for the different course. And in order to give you that, you would have to become a member. These are proprietary stops. Some are based off patterns, others are based off proprietary techniques, and I really can't give away that information right now. Well, we gave you basically 3 of the rules in the 5, or I believe at the most 6 rules in strategy number 4. That was the buy-sell line, the 50-period simple moving average. We also gave you seeing a bar close either in the top or bottom 25% of its range, and then we also showed you how you enter. All those things are incorporated within strategy number 4. We just couldn't give you everything, and stops would be the next thing we'd probably be teaching in the class. Let me see. Coco is saying he's a day trader. This works perfectly well on all time frames. You can use this for day trading. I stated I traded this today, day trading. Okay, this is perfect. Both of these techniques are great for day trading, and I use them today. In fact, I had a nice trade this morning using strategy number 4 as well as the PET D. You can also use it for swing trading if you like. We teach you ways in which to stay in the trade longer if you like. So it really, it's just semantics right now of how you want to trade it. But what we're doing right now is basically showing you a great technique that can be used either for short intraday trading or for swing trading. That's how well it transfers over into all the markets. Jaya is asking, why the 50-period simple moving average and not the 50 exponential moving average for the buy-sell line? This is a good question. It's a kind of a two-part answer. First of all, over all the years I've been trading, and since this was taught to me, the 50-period simple moving average appears to work the best in all markets. In other words, I wouldn't want to say, well, for stocks, use the 50-period simple moving average. For futures, use the 38 exponential period moving average, and for Forex, use the 84 weighted moving average. You know, that would be too complicated. Remember, we're trying to keep things as simple as possible. And if we wanted to pick one that covers all of these different time frames and all these different markets, it would be the 50-period simple moving average. Now, the second part of this question is, it's not because it's some magical number or that it works perfectly 150% of the time, but it's more of the concept, meaning that even if you feel you must use the exponential moving average, the concept really just is, where is price in relation, okay? I'm more concerned that you're not shorting if price is above this moving average, and I'm more concerned that you're not buying if price is below. Why? Because if you do not, then you'll be in sync. I don't want you to be out of sync with the overall trend, and there won't be that much of a difference if you use the exponential, okay? So the main thing I want to instill in all of you is that you want to be in sync with the overall trend, because most of the reasons why you may be losing or maybe you're not consistent is because you're out of sync. So if you feel you must use another time frame in the moving average, or if you feel you must use an exponential weighted, that's fine. Just make sure that you only go long if price is above and you only go short if price is below. Okay? That's the most important thing. Coco is asking, what exactly is the PET-D? The PET-D is a proprietary algorithm, so when we say proprietary, it means we can't really share the inner workings of it. It's based off of momentum. That's all we can give to you. And the reason why we say it's proprietary is because we've had such success with this, we're thinking about possibly leasing this in the future, where we're going to lease this to hedge funds and lease it to more institutional people. And so this is a great pickup right now, because once you purchase it now, you have it for life. But it may be something in the future where you have to purchase the lease every 6 months. So it's proprietary. We want to keep it that way so people won't be able to reverse engineer it. It's just based off of momentum. It's based off of your standard momentum on a shorter term time frame. Okay? Brad asked, how would you use the PET-D fast versus the PET-D slow? This is one of the things you get in course, which is one of the extra bonuses. We have actually two PET-Ds. We have a PET-D fast and a PET-D slow. The PET-D fast is used for basic in and out type of trading. The answer is in the name. It's more for faster type trading. The PET-D slow is for those people who want to stay in a trade longer, so it's showing you that trend longer, and it's, you know, having the bars either stay green longer or red longer. So it depends on what type of trader you are, and we share with you this in class. So this is one of the things where we give you another one of the bonuses, where if you're an intraday trader, if you like to scalp or be in and out quickly, then you would use the PET-D fast. If you're someone who likes to swing trade or hold things for the long, long moves, you use the PET-D slow. Okay? Brad's asking, as a member, how do I get the alerts from you? I joined a month ago and have not received. Well, it depends on what course you have. If you're a strategy member, in other words, you're strategy number 4 member, well, you're going to get alerts for strategy number 4. In terms of if you're a PET-D member, there are no alerts, because the PET-D is just an algorithm. It's just a tool showing you the short-term trend. So there's no real alert. You have the alert right there with the trend. So it depends on which course. I would say contact one of our trade consultants, and they can share with you exactly what you have and alleviate that problem. But if you're just a PET-D member, there's no alerts to be getting, because you have it in front of you. You have the bars either green or red. Okay? Let's see. Is the software MT4 compatible? Yes, it is. So this works on MT4. I know that MT4 recently had some upgrades, but we feel we've alleviated that problem. We had to change everything to meet these unexpected upgrades that MT4 gave us, but we feel that we've solved that problem, and so yes, it does work for MT4. So does strategy number 4. Yes, PET-D is an add-on for MT4, and so is strategy number 4. How long is the subscription in the Signal service? A subscription is a year. And the reason why we do this, Maverick, is because, you know, we want you to know when a signal is generated, mainly for educational purposes. But once you understand the strategy, you honestly, trust me, you will not even need the signal service. You'll be able to look at a chart and say, there's a strategy 4 right there, where other traders will go, what are you looking at? Because you'll see these over and over again, and through your studies and through your repetition, you'll be able to say, I really don't need any signal service because I can see them for myself. And you'll be able to just scan and see right there where strategy 4 is. Plus, you'll have the add-on, which automatically generates the buy and sell arrows that tell you when a strategy number 4 signal is. Okay, so the actual email service is there for a year, but you really won't need it after, I would say, after a couple of months. Coco asks, can I try before I purchase it? No, Coco, we don't have any trials, because what we found out in the past, we used to do this, but people wanted to reverse engineer it and figure a way, and plus we give you all the rules in the course. So once you have the rules, you can say, okay, I copied them and I'll share them with all my friends, and then you can contact us and say, no, thank you, I'm not interested. But now you just got all of 37 years of hard work and everything that I've accumulated in just about a week or so. You've learned everything. So we don't give out free trials. If you're interested in finding out whether people are happy with our product or not, or whether it's worked, simply do a Google search, and you will see there's a lot of people in different forums that really love. In fact, we got a tremendous note from someone in India today who trades our methods, who said, Steve, until I found you, I was not consistent in my trading. I wasn't making any money, and I have not had a losing trade yet. Now, we're not going to promise anyone that they won't lose again, but the point is that we have a number of satisfied customers. We stand by our reputation, and that's really what our guarantee is. So if you're interested, once again, I think our reputation speaks for itself. I've been trading for 37 years. We've been a company roughly for about 6 or 7 years, and we really haven't had a lot of complaints at all. Brad said you're a strategy number 4. Okay, Brad, I would just simply contact the people at the email provided and the number, and you'll see why you haven't been getting the message. A lot of times what happens is we send out the emails and they go into the spam folder, and people think that they haven't received anything, when in actuality they just go to the spam, and you think they're just, they go into your junk folder, where you actually see that you've probably been getting a week or two, a month of alerts, and you just didn't know where to find them. Okay, so check with that and contact our representatives. Bob says, which time frames are your alerts and signals mainly? Well, the alerts are only for daily time frames, because we can't issue an alert on a tick chart. We'd be having somebody issuing alerts every 10 seconds or a 5-minute chart in every market. We don't have the manpower or the time or access to do that. So we'll only give you alerts on daily bars. So if you're a member of the Forex Strategy number 4 course, you will get alerts when a daily bar issues and generates a signal. If you have the stocks, we will show you for stocks as well. Let me see here. Maverick, you're welcome. Remember, one of the things we try to separate ourselves from other people that present is that even though I admit everyone is selling something, and at the end we're trying to get you to become members, I want you to walk away from my presentations and say, well, even though I didn't purchase anything, I got some great information that I can start using. So even if I'm not a member, I can start using the tips and techniques that Steve shared with me today. So this, once again, shows you our sincerity. We're not just here from the minute we go on trying to sell you. I'm really trying to teach you, and I said in the very first 2 seconds of this presentation that we are an educational company. Our goal is to educate you and teach you the same edge that was taught to me that was able to turn my trading around. Because I know what it's like to struggle. Trust me, I struggled for my first year or two, and this is when I was on the trading floor, so I didn't think I was going to have a job very much longer because I couldn't make ends meet. But my mentors taught me this edge and were ultimately able to get my trading consistent. So this is what I'm trying to do to all of you, not to promise you that you're going to be making 500% a month and that you're all going to be millionaires, but to hopefully instill in you these things that will make you consistent so that you'll be able to trade 10, 20, 30 years from now, and not so much worried about that you're going to be making $1 million in the next month. So we always try to give you information, whether you become a member or not, that you can use and trade and hopefully elevate your trading. Now, in conclusion here, if you really want to take your elevator and you want some education from someone who can mentor you and be there right alongside with you, I really strongly urge that you become a member and take advantage of this deal. Remember, if that price is too much for you to make in one payment, we can cut those payments to any time frame you'd like so that you can become a member and get these 2 great techniques through our payment plan. So don't worry, all of our consultants will work with you and fine-tune some type of plan that works to meet your needs. So be sure and don't feel that that price is too high and you'll miss this greatest opportunity because you didn't have $14.95. You can be cutting it down to monthly payments if you'd like. In closing, remember, if you're interested, please take advantage of this. You're getting 2 great techniques for the price of 1, okay? And this is for a limited time only. With the strategy, you're getting the great strategy that I personally use, and you're getting the PET-D, which is a great, great tool that I personally use as well. I'm not lying when I say I use both of them today. In fact, the last 2 days, I used both of them in my trading and had profitable trades. We're not going to promise that everyone's going to have a profitable trade, but we will tell you that we feel strongly it will get you on that road to consistency. And that's what it's all about. So please, if you're interested in taking your trading to the next level and being able to become consistent, take advantage of this great discounted offer we have. Contact us. All you have to do is simply write us an email at trading@protraderstrategies.com or call us directly at 310-598-6677, and we can have you up and running as early as this afternoon, okay? Thank you so much for attending. I look forward to all of you becoming members of the PET-D and the Strategy #4 course. I'll see you next time. Bye-bye.